Good evening, everybody. We're just going to share on the screen shortly a presentation which we'll take you through and then pause at the end to take some questions. So if we move on, Rob. So I'll start briefly by a quick overview of our strategy, just for those who are listening to our investment story for the first time. But Supermarket Income REIT is a specialist UK real estate investment trust, which is exclusively focused on UK supermarket property. And there's three core pillars to our investment strategy. The first of those is long inflation-linked income. The average lease duration within our portfolio as at the 30th of June was 14 years. So that's a 14-year average lease term across our portfolio. And within that, we also target inflation-linked income. About 78% of our portfolio rent reviews in accordance with index-linked inflation reviews. And the second pillar of our investment strategy is future-proof stores. So we predominantly target supermarkets, which we call omni-channel stores. These are stores which fulfill not only physical grocery sales in the stores, but also core online hubs for the operators. And the third pillar to our investment strategy, just what we love about this asset class, they're real assets. And we've got large sites that are flexible, so we can respond to how the operators wish to use our properties now and in the future. And of course, most recently, that's assisting our tenants improve and enhance the amount of online fulfillment they can do at the stores, in line with the growth that we've seen in the UK online grocery market. I'll now hand over to Rob briefly, who's going to take you through the portfolio.
Thanks, Stephen. So headlines as of today, 1.7 billion of total assets in the portfolio. That's 55 supermarkets. Got that 14-year WALT that Stephen's mentioned. 5.6% as the current portfolio valuation yield. And that's been informed by actual transactions in the market, which we will come on to later. Very liquid investment market. EPRA NTA per share today of 93p. And that's and with an EPRA LTV as at the 30th of June of 35%, which has actually fallen further to 34% post the balance sheet date. And then with a dividend today of 6.06p, which off today's share price is around it's between 7.5% and 8% dividend yield. As I mentioned, 55 stores in the portfolio, weighted towards Tesco's and Sainsbury's there. They make up 79% of the portfolio. 93% of the portfolio is omnichannel, and we have a highly affordable average rent to turnover of 3.8%. Total rent roll today 103 million, and that's a very secure income stream, as evidenced by the 100% rent collection since IPO in 2017. And of those leases, 78% have inflation-linked rental uplifts. Stephen on the numbers.
Thanks, Rob. I'll briefly take you through our P&L, and then I'll hand back to Rob to take you through the balance sheet. And then we'll give you a much more flavour of what we've been seeing in the grocery market. But in terms of numbers on our P&L, net rental income increased from 72.1 million to 95.2 million. During the period, we invested around 400 million of new acquisitions, and I'll take you through those shortly, and our total rental income on an annualized basis going forward. But just the other numbers to point out here, after costs and funding, our total adjusted earnings increased from 57.4 million to 72.4 million. That's a 26% increase over the period, which reflects that as we scale up the overall business, it generates overall earnings growth for us. And of course, on an earnings per share basis, that equates back to about 5.8 pence per share. And off the dividend that we paid during the period, that was around 97% covered. And that looks like 100% covered on a look forward basis. There was obviously some drag during the year as we deployed the capital. For those of you who know as well, we had a joint venture investment with Sainsbury's. And we sold that underlying portfolio to Sainsbury's during the period. And that generated sales proceeds of 425 million for us. And that portfolio was sold at a yield that averaged 4.3%. And during the period, as I spoke to on the rental income growth, we reinvested that capital, total 400 million into new assets, and that was acquired at an average yield of 5.5%. So during the period, we've been redeploying capital at a higher yield. And the other notable number just down below, our EPRA cost ratio, which has come down from 16.5% to 15.5%. Again, as the business scales and grows, then our overall cost footprint declines. Next page, Rob. And just take you through our growth in more detail. So 80.2 million was our annualized rent last year. And as I mentioned, during the period, we've deployed around 400 million of capital into additional assets, and that's generated an additional 20.7 million of passing rent for the fund. And at the same time, our portfolio is mostly index linked in terms of rent reviews, and that generated an additional 2.1 million of income. On average, that was an uplift of about 4.1%. So our annualized passing rent looking forward is now 103 million. I'll hand back to Rob to take you through, one last page. Just as I mentioned, the Sainsbury's reversions portfolio. Again, for those of you who know us well, we did acquire BA's stake in that portfolio, which we acquired for 196 million. And then that was fully funded via a leveraged financing facility, of which was predominantly financed via the discount from BA on the purchase price. However, that acquisition did give us a sole seat at the table when we were discussing the disposal to Sainsbury's. And through restructuring how those assets were going to be sold to Sainsbury's allowed us to generate an additional 16 million of value to shareholders as we exit that portfolio. And that worked out at around 1p on an NTA basis. I'll now hand back to Rob to take through the balance sheet.
So those of you that do follow us might be aware that we announced a debt refinancing exercise just prior to our full year results. And the headlines here, so we've reduced LTV down to that 34%, as I mentioned earlier. We've pushed out the maturity of the debt by 13 months to February 2028. Cost of debt up slightly to 3.1%, but that is now 100% fixed for an average of 3 years. In terms of relationship banks, we added SMBC to the lender group and also reduced excess facilities such that now average hold for each of our banks is 85 million. And that means there's significant capacity within those lenders to step back up in future if we required further debt. And we've also reduced the amount of our debt, which is increased the amount of our debt, which is unsecured, which is both the most flexible form of financing, but also the most cost effective at the moment. So that's now up to 61% of that bank debt is unsecured. And then just to show you here why we think 34% LTV is the right level of debt for the group at the moment. You can see top left, that covenant headroom there, 60% is the covenant. Valuations would have to decline by 44% to breach debt covenants, so significant headroom. Likewise, on the interest cover side of the equation, 4.1 times cover versus a covenant of 1.8 times. So we just feel there's significant cover there, but also with the current levels of debt, we're achieving 100% dividend cover. So that's why we feel it's the right level of debt for the group. And then just to mention on the hedging, so 3.1% is the all-in fixed cost of debt. That the term of the hedges is 3 years from today. And that was extended by 12 months at no additional cost. And we were able to use the value of hedges that were put on it earlier in the year to recycle that value into extending out the term of our current hedges. So earnings protected for the next 3 years. Over to Stephen on the grocery market.
Thanks, Rob. Just to take you through UK grocery market. Let's jump to the next page, please, Rob. So overall, the UK grocery market is a growth sector. When we launched the fund back in 2017, the UK grocery market was 185 billion. Today, it stands at 242 billion. That's a 30% growth rate over the 6 years since our IPO. Or to look at it another way, 57 billion of growth in the grocery market. And of course, we can break that down by the various channels that exist in UK grocery. And you can see here highlighted in green, 16 billion of the 57 billion of growth has been attributable to omnichannel supermarkets. I mean, that was our conviction when we launched the fund, that this omnichannel segment, a powerful mix of both physical and online sales, would be the fastest growing segment in UK grocery. And right now that accounts for 16 billion of that growth. But what's really interesting is when we overlay that growth at a property level. And as you can see here, that over that 6-year period, there's been one net new omnichannel supermarket introduced by the predominantly or the major multi-channel grocers, Tesco's, Sainsbury's, Morrison's, Asda. As a result of that, that 16 billion of omnichannel growth is all consolidating and compounding on existing stores. And that's increasing the reversion value of the real estate that we own. And of course, the discount segment in the UK grocery has also had standout growth during the period, the likes of Aldi and Lidl. However, a lot of that growth is predominantly falling on new stores, 525 new stores introduced by those operators. So from a real estate investment perspective, the omnichannel segment is where we see the greatest value in UK grocery. And of course, what we also show here is that rents on our buildings are becoming more affordable for our tenants. The blue line here is grocery inflation, and the gold dotted line is the average rental cap on the stores that we own. And as you can see, through inflation, turnover on our stores is growing well above where the rental cap level is set. So as a result of that, that area we shaded here in green just shows you the upward pressure on market rents because sales in our stores that we own are growing well above rent. And of course, the best way we can express this is to look at, well, what's the rent turnover metrics for our sector? And right now, across SUPR's portfolio, rent to turnover averages 3.8%. So around 3.8% of our tenant store sales are going into rent. The average across the UK is 4%. And of course, that average is incredibly low when we look at other consumer service property sectors, 12% on average in retail parks, up to 20% of turnover on a hotel will be paid in rent. So we think combined, this is placing upward pressure on market rents, and of course that will translate into future reversion values for this property. And as Rob mentioned on yields, thankfully we have seen that stabilize in the second half of the year. As illustrated here, which is the MSCI Yield Index series, the gold is supermarket property. And as you can see, currently that's stabilized in the second half of the period. But what's more interesting is when we look at supply and demand dynamics in our sector. There's been over 1.7 billion transacted in supermarket investments during the period to the 30th of June 2023. And pure market transactions account for about 1.3 billion. Now, of course, as I mentioned earlier, we were 400 million of that transactional activity highlighted here in gold. But the 0.9 billion are new investors who have been attracted to this asset class because of the relative value given where yields are right now. But of course, the other really interesting thing about our market is that tenants, Tesco's and Sainsbury's, are one of the biggest buyers of their own assets. You can see here in the light blue, Tesco's acquired around 300 million of its own leasehold stores during the period. And as you can see, they've been systematically buying over the last 5 years. They recognize the long-term value in this asset class, and hence the reason why they're buying back is to save themselves costs in the future, because they feel that the market is undervaluing this asset class, so hence they're buying it back. And more recently, Sainsbury's buying back up to 500 million of its own real estate. I'll now hand you over to Rob. Take through the portfolio in a bit more detail.
So as we've mentioned already, we were able to dispose of 430 million of assets during the year. That was our interest in the joint venture with Sainsbury's bought back, which included 21 sites in the portfolio at that 4.3% net initial yield. And then on the other hand, we've also been deploying into 399 million of assets, 11 stores acquired at a 5.5% net initial yield. So you can see that accretive capital deployment there. Just to take you through where we're seeing the value opportunities and the type of assets that we buy. So this was Tesco Worcester, which was acquired in April of this year in an off-market transaction. That was at a 6% net initial yield, so slightly wider than our portfolio average of 5.6%. And there were two reasons for that. One is that it's slightly shorter than our portfolio average at 12 years lease term, but also the fact that there's a market perception that the store is slightly over rented, which is, in simple terms, is where the rent is ahead of where a market rent would be today, and it's continuing to grow with that annual RPI linked lease with reviews capped at 4%. But the reason we really like this store is that it's a really strong trader for Tesco, 65 million of total site revenue, which puts it very much in their Q1 trading density, so in the top quartile of the portfolio. It's omnichannel. It's got 9 home delivery vans. That makes it quite a sizable hub fulfilling online grocery to the local catchment. And as I mentioned, it's got that index linked lease. But one of the questions we often get when, as Stephen's just been talking to, Tesco are so actively buying back their own stores, does that not mean that they buy back all of the best quality kit and then we get left with the second tier or even the third tier stores? But the answer to that is absolutely not. Tesco do not have a blank checkbook. And that's how they describe it to us. We've got a very good relationship. We are one of Tesco's largest, if not the biggest landlord. So we have a very good relationship with them. They've explained that they don't get a blank checkbook. They have capital allocation decisions to make. That's between share buybacks, capex programs on their existing store estate, repayment of debt, and then also, of course, the ability to buy back in stores. So this was one they took forward to their internal committee for approval to buy back in. They didn't get that approval, but we know it was on their target buyback list. And we also had a conversation where Tesco approached us after our completion of the acquisition to ask whether we'd be interested in a lease re-gear, i.e. extending the term of the lease from today. But actually for us at a 6% net initial yield, it's a very attractive income stream for us. And again, just to highlight the point that this is the type of really strong, top performing supermarkets that we target and are able to access in our position as sector specialists. We're also looking to add value where we can across the portfolio through asset management, and we do have some larger sites here where we have greater site control. We've got some non-grocery units, and here we're looking to extend some of the retail units to provide discount food stores. So examples here across Bristol, Basingstoke and Newcastle. Very attractive, of course, to the discount retailers, given we own some of the very best performing supermarkets in the country. Well, naturally, Aldi and Lidl would love to be located on these types of sites. Interesting dynamic at the moment. Build costs have gone up, and that means and yields have moved out. So for the economics of new development to stack up, the rents would have to go up. So there's an interesting kind of tension there between rents and the operators, who Aldi have got very public commitments to growing their store estate over the coming years. So for us, targeting a yield on cost of 7%, which looks quite attractive at the moment. So yeah, just positive ways in which we can improve value in the portfolio. And then finally, just to touch on our non-grocery portfolio. So we do own some non-grocery units, and this is very much incidental to buying some of the very best performing supermarkets in the country. They are often or sometimes co-located with other non-grocery retailers. You've got a few examples on the left-hand side there: Starbucks drive-through, Pets at Home, Boots, Holland and Barrett. Those kinds of names that just really do well off the footfall of a supermarket, and likewise the supermarket benefits from footfall there. But really what you're talking about here is where it's too difficult to separate the food store in isolation from the non-grocery units, then in those cases we have the in-house capability to manage those units. And you can see on the right-hand side of the page, very conservative approach. It's only 6% of the portfolio. It's held at a conservative 8% net initial yield, and 75% is essential retailers. And you can just see in the table there on the right, very diverse in terms of sectors, no single sector or tenant exposure. So yeah, for us, as I say, very much incidental to owning the best supermarkets in the country. We sometimes will own and manage some adjacent other tenants as well. Asset management wise, there's a couple of initiatives that we're looking at. So solar, firstly, 20% of the portfolio now has operational solar panels, and also EV charging, 20% of the portfolio now with EV, and we've got 5 sites under construction with Osprey ourselves. But the interesting point here that these initiatives enhance sustainability of the sites, but come at zero capital outlay to Super. And just generally, sustainability is a key part of our strategy. So we had our first TCFD fully aligned annual report this year. Atrato as investment advisor is a signatory of the UN Principles for Responsible Investment and the Net Zero Asset Managers Initiative. We also get very good stakeholder engagement with our tenants. Supermarkets are absolutely committed to net zero, got very ambitious net zero targets of their own. That means we get good data from our tenants, and that's also improving. And then there's also the role in the communities of owning these types of assets, and we work closely with our tenants in doing that.
I guess it's back to me to finish up. So why are we so excited about our sector at the moment? Well, I think this kind of explains it, that the huge investment volumes we've seen in supermarket real estate. A lot of new entrants have been attracted by the fact that this asset class is generating around 12% IRR with a small amount of leverage. And of course, if you compare that to Tesco's bonds, well, the yield to maturity on a bond is around 7.2%. So as a result of that, the relative value between owning the real estate versus owning an unsecured Tesco bond, well, you can see that spread differential just doesn't make sense to us. So hence, we see a lot of value in this asset class. And if we kind of summarize up how we're thinking about this going forward into the future. Next page, please, Rob. I mean, our investment strategy as it is underpinned by a growth sector. UK grocery is a growth market. And of course, that's predominantly growing as a result of the elevated inflation levels. As Rob's taken you through, we have got an enhanced sustainability footprint of our portfolio, predominantly because of the work our tenants are doing, greening their overall operations to become net zero by 2030. Unlike other asset classes, that cost falls on our tenants, not us. And of course, during the period, we've been recycling capital at attractive exit yields and then redeploying that at more accretive entry yields. And we think we've got more of that to do in the future, which will drive earnings growth. But overall, right now, where we stand, we are secured income, given our tenant base is predominantly Tesco's and Sainsbury's, some of the strongest companies in the UK. And off that, our current share price generating a yield of around 7.5% to 8% offers attractive returns on a look-forward basis going forward. And there, we'll probably call it an end. I know we're slightly over on time, but there are a few questions. If it's okay with you, Mark, we can go straight into those and I can compare quickly.
Thanks very much, Stephen and Robert. It's a very interesting presentation. Can I just remind everyone present that if you'd like to ask any questions, just click the Q&A button at the bottom of your screen and you can type your question in there. We've got a small number of questions at the moment, but if you don't mind, before we come to those, as we've got a good amount of time, I'd just like to play devil's advocate and ask you an interesting question. The 10-year gilt yield is currently 4.5%, and your you're currently getting a net initial yield of 5.6%, you said, on your portfolio, which isn't a very big gap. So how do you counter the argument that doesn't look like a very attractive premium over the gilt yield, risk-free gilt yield?
It's a good question, Mark. I mean,
thanks, Stephen.
First of all, there's two component parts of our return. One is the cash yield that we generate through rent. And as you said, off our valuation, that's 5.6 today on average. But of course, the other component part of our return is value growth. So unlike a bond, which just amortizes to its principal number at the end and you get your money back, we own the property. And of course, property values grow over time. So when we think about the cash yield component, that's about 5.6% now. And of course, that feeds through after costs and the benefit of a bit of leverage into a dividend yield, which is 6p per share. But the other component part of our return is capital growth. And if you think right now we've got a portfolio that's worth, that generates around 103 million a year in rent. Well, if we assume that grows 4% next year, that's on average around another 4.5 million of total rent coming through. Now, if you capitalize that rent at property yields, 5.6%, that's worth another 70 million of capital value that crystallizes on our real estate. And over the number of shares that we've issued during, that we've got in total issuance, that's around another 6p per share. So the total shareholder return that we can deliver to investors, the cash element will be around 6p per share. And of course, the capital growth element should be around 5-6p. So hence we get back to around a 12% total shareholder return. And that element we feel looks very attractive when we compare that to the 10-year treasury yield, which you mentioned is around 4.5%. And when we compare that to Tesco's own bonds, which is around 7.2%. So in that respect, we feel there's a lot of relative value here.
That certainly makes your shares look a lot more attractive, which leads on to the first question that Simon has asked here, which is, are you surprised, disappointed with your share price?
Yeah, I can take that first one. So look, it's obviously disappointing what's happened across all UK property and share prices on REITs in particular in response to the increase in the real rate of interest rates. That's obviously increased everybody's discount rate that they applied to cash flows, and that's had a negative impact on property values across the board. But we like to think through our investment strategy focused on core tenants, which are Tesco's and Sainsbury's, that actually our share price has fallen a little less than everybody else. I think across the UK property REIT space, share prices are down about 25% discount to NAV. We're in around the 14-15%. So haven't fallen as much as everybody else, but at that level, we do offer quite an attractive dividend yield, which is off the current share price around 7.5%, Rob, at the moment. So in that respect, if you buy Tesco's own shares, you'll get about a 4% yield. If you buy us, and bearing in mind we own Tesco's properties, their supermarkets, their cash generating units, we can generate or return a yield of about 7.8% cash yield. And as I said earlier, total shareholder return looks closer to 12%. So in that respect, whilst of course the share price reduction has been very disappointing, nevertheless, we're outperforming the rest of the UK REIT market. And off the current share price, it looks like credible value. And hence you've probably seen us as a management team, as well as the board, have been quite active in buying supermarkets, income REIT shares over the period.
Mm-hmm. Yeah, that certainly looks interesting. Just to clarify, the approximately 12% total return, that's on an NAV basis, of course, because you don't have direct control over the share price.
That's correct.
Yeah,
thanks, Mark, for clarifying. Yeah.
Okay. Then next question from Charlie. He's concerned about the valuations of the portfolio and is asking how often the portfolio is revalued.
So there's a valuation every 6 months. The last published was in our results a couple of weeks back, and that was as at 30th of June. I would say we've not seen kind of transactional evidence to date. Certainly calendar year since January has been in line with where we have assets marked in our portfolio. So we're not yet seeing any kind of pressure for further yield movements from here. But of course, the outlook is a bit more cautious depending on where interest rates move to. And I did see what is happening to supermarket real estate freeholds as part of Charlie's question. And if you mean their kind of supply and demand, as Stephen mentioned earlier, we're seeing Sainsbury's and Tesco buying back freeholds. On the other side of the equation, we're seeing Asda and Morrison's undertaking primary sale and leaseback. But I would note that they have historically owned a much greater proportion of their own stores, around 85%. So they've got a significant supply of stores they can release into the market and tap into that as an attractive source of financing, given their current leverage structures. I might go, Mark, straight onto the next one from Sandra there, just around the EV charging rate. I assume that means in terms of the actual power of the chargers rather than the price. So assuming that is the case, they're 300 kilowatt chargers. So they're the ultra fast model. But of course, supermarkets are a great place to charge your EV because of the dwell time in general. So we've seen the operators rolling it out, but we're also doing it ourselves where we have that site control, as I mentioned earlier.
I'm pleasantly surprised to hear that you have those ultra fast chargers. I think that's quite unusual. Good stuff. Thank you. Okay, yeah, interesting question from Mark Waters. What was the process that Sainsbury's used for deciding which stores they bought back from the joint venture?
Yeah, I can take that one. So, I mean, there was 26 stores in that joint venture in totality. And Sainsbury's, like most organisations, have a budget from Treasury on how much they could spend buying them back. On a gross basis, that was £1 billion. But of course, Sainsbury's, it was a joint venture. They owned half of it anyway. So on a net basis, it was around 500 million. And that equates to around 21 stores. Now, of course, because those leases were coming to expiry, they had an option to buy them all back if they wanted to. But given the price that was attached to the value of those assets, 21 came to roughly 500 million net cash outflow for them. So the other 4, they wanted to stay in occupancy too. And hence they entered into a new lease on those, which we've retained in our leasehold investment portfolio. So in that respect, that was the nature of the transaction. And I think what it does show, and we did reiterate it on that graph with who's buying in this market, it's the fact that our tenants are buying back their own stores. I mean, for us, it's not only good independent price verification, what are these assets worth, but at the same time, it shows you how they think about long-term value in this asset class. They'd rather own them than have them in the leasehold market. So as Rob said, they need to dip their toe quietly in the market because, of course, people will see them coming if they did too much in one go. And they have allocated budgets from the Treasury teams. But nevertheless, the direction of travel is that this asset class is shrinking. And we think we're unique in UK property that the investable pool of assets is declining.
And how did they select the 21 stores out of the 26 that were available potentially to them?
Sorry, Mark, go again.
Do you know? I don't know if that's something you know, if you know how they selected them.
Yes, it was kind of a decision around, well, of which ones would you retain as supermarket income REIT because they didn't have the money to buy them all back, and which ones they wanted to buy them back. So it was an iterative process. Of course, they bought back some of the best ones in that portfolio, but nevertheless, the ones that remained in the leasehold that we retained are equally good stores. The nature of that portfolio was that they were some of Sainsbury's best stores in the country. The actual sales profile of those 26 stores was 7% of Sainsbury's total UK grocery, but it represented around 4% of their overall grocery footprint. So you can see the kind of weighting towards the upper quartile trading level on those assets. If that
so
makes
there was
sense.
A negotiation process with you on which ones they bought back.
Exactly. Exactly.
Process. Well, that's good. Thank you. Okay. Yeah, another good question. So, what keeps you up at night? What are your main concerns? Everything sounds wonderful, but there are always risks in investment.
It's a good question from Andy, and it probably links to Mark's question on Asda and Morrison's, which I'll let Rob take. But what can go wrong for us? I mean, look, we've had 100% rent collection since IPO. We deliberately pivot our investment strategy towards Tesco's and Sainsbury's because they're some of the strongest companies in the UK. And we've got long leases, so very little frustration on our income. I think what could go wrong for us, of course, is funding costs. We do use leverage to increase returns, and therefore we are exposed to interest rates. But as Rob said, although there has been an increase in interest rates during the period, and that's had a big impact on capital values, we've fixed out our interest rate risk now for the next 3 years at 3.1%. So certainly for the next 3 years, our interest rate volatility has been fixed out. And that was our strategy, was to hedge out through the uncertainty period on interest rates. Of course, there is covenant risk within the market because Asda and Morrison's are private companies. And Rob, it's probably worth how we think about Asda and Morrison's.
Yeah, I think from when you're investing in supermarkets, it's very important you understand very much the local market. The operators look at grocery as a localized market. The CMA looks at it as a localized market when reviewing whether one operator can buy a store from another. The CMA will review drive times over both 10 and 15 minutes. The reason being 85%, 90% of consumers will not travel more than 15 minutes to their supermarket. So it's important that you understand the performance of a store within its local catchment. So we own some very strong Asda's and Morrison's in the portfolio, but the combination of those two covenants is around only 6% of the portfolio. And as Stephen said, we're focused on the investment grade covenants of Tesco's and Sainsbury's. I think our investors like that weighting. So I certainly wouldn't expect us to materially increase our exposure to the likes of Asda and Morrison's. But that said, if we did selectively, if there was a dominant store in a catchment, a really strong performer, well, actually with grocery and supermarkets, it's very rare you will see a supermarket vacate a site and another supermarket operator doesn't step in. These sites are very hard to come by, 9-10 acres in a dense residential catchment. If it's a strong performing store for one operator, it will be a strong performing store for another operator. So that's why it's very important to underwrite at the local level and to be sector specialists, which of course we are. But in short, in answer to the question, no, I wouldn't expect us to be increasing our exposure there. Our investors in the equity markets like the weighting towards Tesco's and Sainsbury's. And Mark, I've seen that final question on there from Cliff. I think that one might be a difficult question for us to answer, given you almost stray into forecasting territory. I think from our perspective, as we say, SUPR, we pointed to all the kind of key highlights with the structure, and it's still on the screen here. The weighting to Tesco's and Sainsbury's, the inflation-linked rent reviews, the fact we have had 100% occupancy and rent collection since IPO. We think all of those aspects make it a defensive investment, and then the dividend yield looks attractive on top of that. I don't think we can comment on kind of future share price movements though.
No, clearly not. Related to that and the previous question, which is why I left it open, your debt at the moment, it first comes up for refinancing in about 3 years. As that approaches, if interest rates haven't reduced much from where they are now, will you be looking at reducing your leverage?
I will take that one. So I think, yeah, we're modelling forward. When you look to where kind of rates return on a more normalised basis, our hedging gets us through the peak in the interest rate curve, and certainly market expectations of rates. So if that is kind of what happens in practice, then we're looking forward to kind of long-term dividend cover. So I think for now that's kind of base case scenario for us. If kind of anything changes, we can reassess. But you have to remember we have our annually increasing rent roll through those contractual uplifts, and that helps to offset increased debt costs. We are only at 34% LTV today, so relatively lowly levered. So as it stands today, we kind of don't see any pressure to be needing to reduce that level of debt.
No, I guess you could. There's a certain element of wait and see on that. But you know, everyone is expecting that hopefully in that time frame interest rates come down. But as Yogi Berra says, forecasting is difficult, especially about the future. So who knows? But I guess that's something it's a bridge you'll have to cross when you come to it.
Yes, but it is encouraging to see the yield stabilize in the second half of the year.
Yeah,
I think a lot of that has been the data points around UK inflation, which seems to be coming down now, especially core inflation. And of course, interest rates are a policy response to high levels of inflation. So the direction of travel looks good. So in that respect, we're cautiously optimistic that we are over the hump of the interest rate risk in the UK. Where it lands is anybody's guess, but we feel we're fairly confident now that we've hedged out at 3.1%. So in that respect, we've de-risked our interest rate volatility exposure.
Yes, that does give a good degree of comfort. Okay, then Mark's added another question here, which I think is another good one. Do you see further development opportunities on other sites besides the 3 that you mentioned in the presentation?
I think for us, look, the development is a nice opportunity to generate some additional returns for shareholders, but it is always going to be a relatively small part of the portfolio. We gave the 3 examples there. There's probably 6 sites in the portfolio where there's opportunities such as that. But of course, they all take time. Wouldn't expect more than a couple of those to be active at any one time. And you're talking development values of, say, 10 million per project in the context of a 1.7 billion pound portfolio. So look, it's not going to be a hugely material part of the business for us, but it is a way that, of course, as you would expect us as investors to be doing, to be maximizing values from the portfolio.
That's useful to understand that. Thank you. Well, that about wraps up the questions. So that was a very interesting presentation and series of questions. And I'll just say thank you, Stephen and Robert. And we hope to see you again, perhaps at the next interims when there's been more progress.
Thank you very much for having us.
And I'll
Thanks,
just
everyone.
wrap up on the meeting now. Thank you.
Have a good evening.